Netflix. Earnings just coming out, and on the revenue side, the sales at Netflix last quarter were better than expected, $6.15 billion in quarterly sales. That compares to an expectation of 6.08. Now, earnings were light. The stock is way off, and after hours trading down 12%. Earnings of $1.59 last quarter, well short of the estimate that had been put in of $1.81. Also, just real quick before we bring our panel in to talk about this, the outlook on the revenue side for next quarter looks a little light at $6.33 billion, although earnings next quarter, the third quarter, are going to be above, according to Netflix analyst estimates. As we go through these numbers in some detail, I want to bring in Dion Rabon from Axios, the markets editor there, and Gary B. Smith from Kadena Group, Gary, a Fox Business contributor. So, as I say, guys, that we're going through this, and we'll start with you, Dion, we're looking for the subscriber number. That's always the driving force with Netflix, and the estimate was for over 8 million new subscribers in the quarter, which is ridiculous. But the stock is selling off here, so it seems, and it might be that, there's a little bit of a disappointment. I wonder if we were set up for disappointment no matter what Netflix reported with the way this stock has acted. But take it first, Dion.
Yeah, I mean, when you've got a stock that's up 63% year to date, while the broader S&P is negative for the year, naturally you're going to have some very high expectations. I think, and last time we talked about Netflix, I think I said the way they were setting themselves up for this quarter in terms of issuing that guidance may have outkicked the coverage a little bit, but you've also just got really bullish investors. Folks are very bullish on Netflix. Number one, they've had solid numbers. Number two, it looks like the coronavirus is coming back in certain parts of the country. That sounds bullish for Netflix. I think the expectation was they were going to over-deliver, and you had call options set up really significantly in favor of Netflix getting a beat. So maybe just folks getting a little too bullish and Netflix not delivering at the spectacular pace that we're used to. But these numbers aren't terrible, and certainly I think the number you're seeing is much more about positioning than about, a particularly bad number for Netflix.
And even though sales, Gary, were better than expected in the most recent quarters we have on the screen, as I said before going to Dion, the guidance for the next quarter sales-wise at $6.33 billion, that's a little light of the estimate. And again, the same type of conversation with you. With the stock up as much as it had been, I guess no surprise to see it pull back here after hours. Your take on Netflix?
Well, I tell you what, Connell, maybe I'm in the minority of this, given what Dion said. They're up 63% year to date, but I have to think the best days of Netflix are beyond them. Here's the reason why. It reminds me of IBM back in the 80s. They were the king. They were the source. They were the only ones for any really kind of computing, particularly mainframe. And then they started to get nibbled away by the Wangs and the Amdals and all the other competitors. Look at the Netflix landscape. It used to be they were the only ones. If you wanted online and, going way back, even before you were born, Connell, get the discs through the mail, that was it. That was your only choice, subsequent to Blockbuster. But now they're a content provider. And they've done a great job. But now who do they have? They have everyone from Disney Plus to that new Peacock thing to HBO. Everyone has an online offering, and they take their own libraries with them. So now Netflix has to produce a lot of their own stuff to replace the things that have gone away, like Friends that they had access to. It's a very difficult, dangerous landscape. I like Netflix. I still pay Netflix. Most people don't even know what they pay in their Netflix subscription per month. I don't, to be honest with you. But the competition is going to get really fierce.
I love that, Gary. That Peacock thing. There's all kinds of streaming services out there. You're right about that. I will give you, Dion, a couple of other headlines on Netflix that, maybe are bothersome to some people. Number one, they're expecting their paid net additions to be down when you compare it year over year in the second half of this year, which maybe goes into that theory of, well, you're getting all you can get out of Netflix in the short term. The other headline is that they're slowly resuming productions in many parts of the world, which brings us to the conversation, Dion, that we always have about Netflix, is that for as much as things might be saturated here in the U.S. and we all have it if we're going to get it, that's not necessarily the case in other parts of the world.
Yeah, and look, the story for Netflix is they've got to keep growing. This is a growth stock. Their debt to EBITDA is bad. Their actual revenues versus the price of the stock, not great. And as Gary mentioned, there are folks out there who think this thing is run as far as it can. I'm going to tell you right now, I wouldn't bet against Netflix with your money, Connell, but there are folks who don't believe in this growth story, but Netflix has consistently delivered. I do have to say those numbers are going to disappoint a lot of folks on the street. If that guidance, because of the coronavirus, and I think a lot of companies are getting the benefit of the doubt, and as long as you're issuing some kind of guidance, I think it's something like a third of the S&P has pulled back any kind of guidance going forward. So I think any kind of guidance investors are going to be more forgiving of. I think we'll see a bump in Netflix as folks come out and buy the dip. But yeah, that is a concerning number because it's all about growth for Netflix.
Now, in terms of its overall paid subscribers, I don't know if we've gotten this on yet, guys, Netflix did add more than expected in the last quarter, the one that wrapped up the second quarter, because we talked about everybody staying at home and the like. And that number now, just wanted to be sure before we said this, that number of, this is a crazy number, was 10.09 million paid subscribers globally. Now, the analyst's estimate was 8.07 million, Gary, and in the year-ago period, the number was under 3 million. It was 2.7 million. So that just gives you an idea. Right. Like a year ago, we thought Netflix was great, and they were adding about a little under 3 million. Now it's over 10 million. We may get caught up in a stock that's selling off based on guidance or whatever else, but that's some number to be adding subscriber-wise in a quarter.
Look, it's phenomenal growth, and the thing is, it's one of those things. It's not like going to the supermarket where every time you go, you have to pull out your card or give them cash, and you go, oh my gosh, I just spent another $100. Like I said, with Netflix, they get the subscribers, and they're kind of just locked in. It's like those Book of the Month Club. You just keep paying it. How much am I paying? Who knows at this point? But I will say the flip side is, and I get back to that content. Each of those subscribers, they make less money unless they keep raising rates, which they can, because now they have to pour all that cream that they had, because it really cost them nothing after they had all those libraries, the old movies and stuff. They have to make the new product now. That costs a lot of money. That's what you saw with the networks, the ABCs, the CBS. They ran into those problems. They're still running into the problem. They have to pay a lot to produce the next Seinfeld and things like that. So they can keep growing. That bottom line number is absolutely fantastic. Just their profit margins, as they, even in this report, are going to continue to get squeezed a little bit.
Yep. Last word to Dion. As we said, a little bit of concern about the future. This may be inside baseball, but for people who follow the company closely, a guy by the name of Ted Sarandos, who's the chief content officer, they've just announced has been appointed as the co-chief executive officer at the company, and will stay in that current position as well. Dion, last word here on the competitive landscape. I mean, there's been a lot said about, say, Disney Plus in the last few weeks, I think because of Hamilton. But the competitive landscape has certainly picked up with all of us staying at home. But you still like the way Netflix is positioned, big picture?
Oh, absolutely. Look, people aren't ditching Netflix for Disney Plus. They're getting Netflix and Disney Plus. They're getting Netflix and Peacock. People aren't leaving Netflix. And when it comes to that content piece, all I got to do is go to the debt markets. The Fed is keeping rates super low. You go borrow more debt. Their debt to EBITDA is a mess anyway. No one cares. Go to the markets, borrow more money, get more content. That's the solution.
All right, guys. Thanks. Good analysis. Bottom line on Netflix. Earnings were light. Sales were better than